Could a future massive home equity withdrawal finally push the housing market over the edge? Well, we're going to find out in a second. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is July the 16th. We're basically halfway through the month. Time just keeps moving on as fast as possible. Tons and tons of things happening right now in the housing market. Randy Patrick here, putting the realism back in real estate. Hope you're doing well, and let's get into it right now. But first of all, what I'm doing next week is actually having a live presentation. It's going to be on the Facebook channel, Housing Bubble 2, the sister channel to this medium right here. I'm going to talk about what's happening and where the market's going to go and how it's going to play out. So I'm actually going to detail step by step what I think is going to happen, what other people have been input into my realm as well too, and we'll just go through that. So it's Wednesday, July 21st, 8 p.m. Eastern Time, 5 p.m. PST. There's no registration, whatever. Just go to the Facebook page, like it, follow it. Once I go live, it should notify you, and you can pop on and listen to it. We'll also have some time for Q&A. So again, Wednesday, July 21st next week. Check it out, and we will go from there. All right, so history does repeat itself, and that's what I want to talk about right now. So I want to realize that there is a lot of videos out there going on about the Wells Fargo issue. This is not the Wells Fargo issue. Wells Fargo is shutting down personal credit lines. This has nothing to do with it. This really is revolving around home equity, all right? And what I'm going to say here is it's just like the previous housing crisis. So when I say history does repeat itself, a lot of things that are playing out or going to play out in the housing market did happen before. Yeah, maybe some little twists and turns here and there, but pretty much the baseline stuff is already happening. Now, it's important though because we have to follow where this is going and who will be pushing for this. And that's why I think it's really interesting to see how these things are going to play out. So I basically, and here's kind of my, very rudimentary slide on what I'm talking about here is house and pulling money out of your house, right? We all heard the term back in the previous housing crisis about using your house as an ATM. Well, I think people have started to do that, and we've seen home equity lines sort of just slowly gain more steam and momentum, and I think there's going to be a real major thing happening the next little while with home equity. So ultimately, I saw this article. Of course, I get on all different blogs and research sites and whatever, and I'd like to take a look at what's going on in the industry. I'd love to hear what other people have to say. So ultimately what we did is we checked this out here. This is a guy's name's Mark Hansen. I'll put a link to this. Evidently he's a consultant and he talks a lot about the mortgage industry. I guess the number one thing, and he doesn't put much out there, but when he does, it's usually pretty spot on or pretty interesting. So what he's talking about here is that there's the biggest opportunity in the history of credit, fintech, and prop tech. A home equity withdrawal mega super cycle meets a 2002-2006 style credit easing cycle wrapped in a financial inclusion, education, and wellness mandate blanket. So that's a lot of stuff to sort of, I guess you could say digest. But really, he's talking about, he thinks that, the next 5 years would be a massive home equity withdrawal and credit easing super cycle. And, that's inspired by what? Inclusion, education, wellness, debt consolidation, consumer spending, subsequent re-leveraging boom. So it's all kind of, wrapped together here. Now, why this is going to happen, or this could happen, is because there's $23 trillion in home equity. And it's obviously, we're at the massive amount of home equity. And as he's saying here, it's 100% larger than where it was in 2007. And soon it will be the central focus for homeowners, pure play mortgage and housing companies, all directly and indirectly related companies and investors, lawmakers and regulators alike. So what he's basically saying here is that, this is going to be where things are going. This is going to happen in the near future. People are already working on this. There's already government involvement. It's already like stuff's being laid out. The game plan's being laid out, etc. So how are we going to get involved and how are we going to look for this? So basically is locked in equity is the problem, and it's the opportunity in the post-COVID-19 era. So basically, 23 trillion in home equity versus 11 trillion in the peak of the bubble, basically with tens of millions of homeowner families who are unemployed, underemployed, living off savings, high interest credit, government aid, and the backdrop of the average FICO score for all mortgage originations in Q1 21, is about 785 and less than 10% below 685. basically what he's saying is that the people who need access to credit, they're not getting it. The people that need it the most from the banks, credit unions, non-banks, lenders have not really helped out the people who need to tap into their equity to solve some of their financial issues. All right. So what we're looking at here is that the result is that the people who need credit the most simply don't qualify for the few narrow and rigid home equity products on the market today, largely, gated by FICO, which has systematically excluded tens of millions of people for decades, especially the underserved. Well, so that's really kind of kind of obvious. I think a lot of us understand the credit market. A lot of people out there understand it and know that the credit market just doesn't reflect a lot of the reality for today's borrower. And as he stated, it's the people with the really good credit, the stable jobs, the whole bit that can tap into their equity, or they can do things with mortgages, where the people that really need the support can't get it. That's problematic. But those things are probably going to change over the while. So when those that need credit least can easily get it, and those that need the most can't, it's the definition of a credit crisis. So we're actually in a credit crisis is how he's talking about. But because mortgage volume has been so massive past COVID, nobody's paying attention to this market and this distribution of it. So obviously with the past, year, 6, 7, 8 months of people buying properties, housing prices going up, people buying property, low inventory. So when all this is going on, there's no focus on what really needs to happen. So basically what he's saying here is the home equity scenario is the credit box about to blow open like after 9/11, led by the Biden administration, the GSEs, which are government-sponsored entities, which is Fannie and Freddie, HUD, Housing Urban Development. And now that the admin fully controls the GSEs and FHA and will pressure portfolio lenders to fall in line using COVID, financial inclusion and equity, and the good old government already owns 95% of the risk mantra as cover, there are a few barriers left to a mass home equity extraction cycle event. So this is very interesting and this is very important. So think about that for a moment as he's saying here. $23 trillion in untapped home equity plus a credit box effectively as loose as 2002, 2006. Now, what happened before the previous housing crisis? So as we ramped up to 2002, 2006, basically we had looser mortgages, lower credit standards, lower lending standards, and people took advantage of that. That did start part of the previous housing crisis for sure. This adds up to an impending equity withdrawal super cycle that will make 2002 and 2006 look tame by comparison. Now, going and speaking about a lot of the housing narrative, because you know how I feel about that, a lot of people who talk about why we're not going to have housing crisis or housing crashes or housing issues is because credit standards are tighter, which, yeah, they are. And obviously people, and they're also saying that people aren't able to pull out I guess you could say dollar values out of their homes like they used to before. That's true. We've seen home equity pull withdrawals increase over the past couple of years because that's, I guess, constant with the rise in equity, but it's still, I guess, with that certain credit or demographic of credit standard borrowers that are allowed to tap into it, where those that need it can't. So what he's basically saying here is that huge opportunity here, but with every opportunity, there's I guess you could say things that you can't foresee or don't want to foresee, or consequences of stuff. So we're going to talk about that in a second here. So I do think this is kind of a great point in time where we're talking about this right now in the housing cycle. But first of all, if you're not already subscribed to my channel, if you could please help my channel grow and subscribe, I'd really appreciate that. So thank you. And also, as I've mentioned, lots going on with the subscriber base behind the scenes. So if you think you're a subscriber or feel that you've already subscribed, if you could just try it again and check it out and resubscribe, and help me as well, because stuff changes from time to time. I ebb and flow with subscribers. So thank you very much. And I do really appreciate those who have come on board. And after all these past couple of years, the channel has grown, which I do appreciate. And I have a lot of great comments and commentary on there too. So the majority of people, 99% of the people that are inputting and adding comments, they're proactive, they're good comments, they're respectful comments. And I do wanted to say that I do appreciate that, as opposed to a lot of other channels who from my reads on the comments, have a lot of negative stuff going on. So again, thank you very much. So now that Mark Calabria has been ousted from the as the director of FHFA, the administration has put in their own person now. So she has the winds behind her to blow open the mortgage credit box, both by expanding what the GSEs will buy, but more importantly, addressing the real obstacle, which is making GSE seller servicers, mortgage lenders, comfortable with taking on the risk outside the cookie cutter high FICO loans they've been making. Okay, so that's what it boils down to. So ultimately, what we will see is that I think we'll see some changes with credit and how it's scored or how it's managed, but we're also going to see loan products that will open up more credit opportunities for different credit level scores. So it says that Congress is taking on the credit bureaus. The hope is to create a brand new super credit bureau controlled by the CFPB. Government-backed credit flowing everywhere by wiping the slate clean, because bureaus don't do much but collect data. Rather, it's fundamentally and fatally flawed traditional credit scoring algorithms that have been excluding tens of millions of people from liquid credit markets for decades. So really, the system is flawed. It doesn't reflect as to what's going on now, and we realize that. But as I said, this is where they're headed. So one of my things is looking at one event or one issue that I talk about doesn't necessarily change the market, shift the market, or cause a housing distress element or credit crisis or whatever. But when you add all these smaller things, or this is still major, but all these things up together, that's where we see some problems. And as if they all hit at once, that's where you have issues. Now, throw all this into the volatile housing market in the mix, because buyer sentiment has turned downright bearish per the most recent Fannie Mae National Housing Survey. Now, if you check that out, I didn't do a video on that because I don't think it's all that worth videoing. But ultimately what it boils down to is that today's home buyer think it's the worst time to buy a home. So home buyer sentiment is poor, all right, for various reasons: lack of choice, lack of mortgage programs. They don't want to pay the seller's premiums, low inventory, competition. As I've mentioned before, and this is a widely published sort of I guess you could say commentary on the housing market. Most people today that are say what's the most stressful events of their lives is buying a house. All right, it's not getting married, graduating, new job, having a baby, starting a family, other lifestyle changes. It's buying a house is apparently the most stressful event people believe they will encounter in their lives, which is actually pretty sad to see if that's where the state of the housing industry is. All right. So as we all know, lenders are going to lend. Purchase volume is contracting swiftly. So we were also hearing right now from various sources that more inventory is coming on. Sellers are not getting those offers they used to get. So now more sellers are going, well, I've waited all this time, I want to cash out now. So of course, when more inventory comes on, it does shift the market a bit and means there's some choice, and sellers may not get that top dollar. So things are actually happening right now, and so I guess you could say that things are stewing. But if you can't sell, so if you were hoping to sell at the peak and you've missed the peak and now things are starting to move in a different direction, well, what are you going to do? Well, maybe I can unlock some of my home equity and use that to pay down bills, give me some play money for things like crypto and buying gold and silver or other assets. Who knows, right? So that's what I think is going to happen. And really, as you said, we're basically, all these events are stacking the deck for a home equity extraction super cycle. It makes sense. Buyers are pessimistic. That's because markets are frozen with mostly perfect deals trading at the margins, at or above ask, lifting values for all homes. As such, prices are at a point which only a small slice of a local population earns enough to buy what few houses are for sale. That's discouraging for sure, reminiscent of the end of the first housing bubble between 2005 and 2007. So it's kind of like he's actually saying, look what's happening here, guys. We're really going through the same situation that we went through with the last housing bubble. And I mean, obviously, I concur on that. But one of the things that did happen with the last housing bubble is equity stripping, and that was a big time thing. So a lot of people, I guess you say, relate the mortgage meltdown and the subprime mortgage crisis with the housing crisis. Well, this subprime mortgage meltdown was the initial part of the housing bubble, boom, bust, crash, the whole bit. So that did play a part. It started it off. But the real culprit was, and again, the subprime was about 20%. The real culprit was home equity and equity stripping. Okay, people basically refinanced, took cash out, refis the whole bit, thinking the market would keep going up, and then other things hit and happened, which caused it to change, and now you're stuck having a refi and a mortgage maybe you can't pay or don't want to pay anymore, etc. So, all right. So, and how he puts it though is just think about it this way: the government and the Fed have already spent and printed trillions of dollars on COVID stimulus packages, care packages, whatever it is. So unlocking trillions of the 23 trillion equity sitting untapped through data-driven intelligence and new innovative credit structures, basically is basically better aligned. I guess that's the whole point. Like, in other words, that's where they're going to go. So, in other words, the government's not going to pay for this anymore. You're going to pay for it. So, you want access to get yourself out of debt. You want access to buy and invest. You want access to other money. Well, if you can tap that home equity line, then the government's going to push you to do it, or push lenders to make more programs available to allow those to do it. So traditionally, or not traditionally, but I guess traditionally back in the day, everybody's able to strip out their equity. Right now, not as many people, even though there's still, listen, don't think nothing's happening in that marketplace. There's still been a heck of a lot of home equity loans being taken out, but when comparatively speaking, we're probably 50% or so as to what happened in the peak of the last housing crisis. The minute they open the credit box up for here, I can see that, as he said, we were talking 10 trillion, now we're talking 23 trillion. So the numbers could be enormous as to what money could come out. And as they said, lenders are going to lend. This is going to be definitely a thing that they're going to look at. So ultimately, in the end, this is what's going to happen. Now, from my perspective here, is that a good thing or a bad thing? Well, I guess it depends on where you sit on this. I don't think it's. I think people need to get access to credit. I think not everybody fits in that box, right? That's the problem. As the world changes and opportunities change, employment changes, people doing self-employed, people doing gig work, the whole bit. So those, that segment is, needs to have a better credit facility for sure, because they don't fit in the box. I don't fit in the box. I mean, it's tough, right? So, that's the things. But so that's the good part. But on the other hand, it could go wild, right? And which we have to be careful of. So, and he's saying, yes, I'm aware this sounds like the bubble years of 2002 to 2006, a redo. I think it's inevitable, but much more powerful this time around. It's where I'm focusing on my time, thought, and capital. Capital always flows where it's needed the most and gets the best risk-adjusted return. So equity extraction, first, seconds, and participation products down to the 500 FICO score will attract an ocean of institutional and opportunistic capital over the next several years that lifts all the boats. So ultimately, that's what he's saying, is that he believes that we're going to see more products designed to lower FICO score, we'll call it market segment, which opens up for a lot of equity extraction. So, and what can you, now clearly what's home equity for? The basis of home equity is for, hey, I'm going to take out a home equity line. Okay, I'm going to utilize it as a revolving credit line, and I'm going to either pay down credit cards or use the equity to, well, typically the home equity line should be used for, and I think how they sell it, or how they at least talk about it, is the fact that you take the equity out of your home to make home improvements, which in the end, values your home higher. So then when you do sell your home, you're paying that equity back, plus a margin on top of that is going in your pocket. So the money's been well spent on improving your home. But we all know what happened through the last housing crisis. That was not done. People use it to invest, but people use it to buy cars, boats, big screen TVs, the whole bits, and with no intention or not thinking they'd actually have to pay it back, or the market was going to change. So that's kind of where we're at again today here. So to me, this is one more thing that sets us up for, I don't know how can I put it into words? It's volatile, and it could be problematic if it's not managed properly, because there will be people who will use this appropriately, and there will be another segment of population who will go, great, I can just take stuff out because I'm desperate and I can do A, B, C, D, E, F, G with it. And in the end, is there, maybe they've done some short-term debt issues or financial issues, but in the end, have they helped themselves out in the long term, which puts them in a precarious situation, which I think that's where some of the people out there, some of the powers that be, want the market to go. The more debt you have, the more risk you have, the closer you are to going underwater, the closer you are to not paying, which ultimately gets them where they want to go as wealth transfer. So this is how I look at it. In the end, that's where this is all going with Wall Street, the government, whatever, is wealth transfer. Doing more huge extraction on home equity just sets that up like the last housing crisis. So that's how this guy's connecting the dots, and I certainly believe and understand what he's talking about. So what could happen if this credit extraction opportunity, if it's a yes, it's a go, and things change? Well, a significant amount of value is extracted from the housing market at the peak. You see, so we're at the peak now, so it'll still push things forward, and money will be extracted, but it'll leave homeowners on the hook with much more housing debt. And what I mean that they could be susceptible to future payment issues. So they've taken out more, they've used the money, have they fixed their financial problems or the reason why they were having issues in the first place? Who knows? Susceptible to payment issues. Also, the more you take out the peak market, if there's changes in the market, because what they're not even talking about here is, hey, what about future foreclosures? What about forbearances that are coming due? All those things that we don't, the narrative doesn't really talk about, or doesn't talk about it in the true light as to what could happen here. So that could be precarious for this market, okay? And as I say, we know where this will go. Equity stripping was the #1 issue in the previous housing crisis, all right? You can take a look at that. As I said, 20% of the market was subprime. We have subprime today. FHA is subprime. What did I talk about last video? I spoke about the fact that, now FHA is offering 100% zero down loans at the peak value. So it's almost like it's what's what I'm looking for? I don't know the right word. It's ridiculous, but it's almost like you got it. Like, it shouldn't surprise you that at the peak value we're allowing people as much rope as they want to hang themselves. And this is yet another example of what could happen with equity stripping. And realize that home equity lines are a little different qualification process. You're not going through, home equity line is not a refi of your mortgage, not a cash out refi. It's going to your lender saying, hey, have you got a product where I can tap into my equity? They give you like the revolving credit line, so you could use it or you couldn't use it, but the temptation's there. All right, so this is what happened in the last housing crisis. That's why when I say history repeats itself, we are being set up for this right now. What could happen if no? Well, if these products don't come to market or take too long to come into market, well, the homeowners that actually, so that he talks about the credit challenged that need it the most, that can't get it. Well, what's going to happen is that they can't tap into their equity. So these homeowners will continue to slip further into financial issues and non-payments. They'll chip away at their equity. They'll eventually, they'll get out of forbearance or have other issues. They'll go to loss mitigation solutions that may or may not work for them, and they'll start going down the path where we talk about the pre-foreclosures and things like that. And I want to be clear here, okay? They'll be forced to sell. Why? Because I need to use my equity to get me out of this jam. But you see, as I said, part of the housing narrative is talking about homeowners today who are facing financial issues. We won't have a housing crash or crisis because equity will solve everything, right? Well, today's equity, if I look at what you owe on paper and today's equity, it might look good because they're doing analysis on loan origination and this equity, right? Now, the people who do the analysis, all the data companies, they don't know how long you haven't paid. They're not calculating what you owe and what's due for all the non-payments, cost issues, whatever. And also, the assumption is that if you're going to sell your property, are you going to get top dollar for it? So we already see that maybe that's not actually happening. And like anything, if you want to, you're going to put your house on the market, so is your neighbor, so is the person down the street. The minute that happens, there creates more inventory, which creates seller competition, which means buyers go, I don't have to pay your premium, and I can start actually lowering my price. I also believe that a lot of people in this situation, that they can't actually put their home out for a premium because the numbers don't work for them. That means they're going to list it with a real estate agent. It's closing costs and commissions. But also, if they want to sell for a premium, then they should be doing things like adding curb appeal or fixing repairs or pending, like doing the small improvements or things you need to do to get that big number. If you're already in a financial situation where you don't have the cash for that, you're not going to be able to put that money into your home to get the value out of it. So therefore, your home won't look as nice as the next person, which means you're going to get lower offers. So it's all, see, you can see how this is all going to sort of step its way down. Or what's going to happen is that you've got nowhere to go. So right now, you can't get another place, you can't rent, you can't do whatever. So you're handcuffed by your house, which fuels more distress because you're simply going to wait this out to the end where you are going to chip away at all your equity. You are going to fall out of those situations with forbearance or loan mods, or it's not going to work for you. Then you're going to become another statistic, on the pre-foreclosure side, which means quick discount sales just to get out, or short sales, etc., and going to foreclosure. So the market will change from that perspective here. So it could go two ways. Now, I obviously I was a mortgage broker back in the day, in the last housing crisis. I mean, everybody was, right? But as far as I'm concerned, but I don't do that right now. But I guess I look at this going, what's the next thing that's going to happen? This is the next thing. So I do believe what he's saying in this article, the fact that we're probably going to see things change because once the government's tapped out, where do you go? Well, you go to where the money is, right? So all this home equity sitting there, and if things are going to be status for a while, people will start to tap into that, and that will change, sort of the face of the housing industry, and then push us down places maybe we don't want to go at this point in time. But as he said, it's inevitable in the near future. So that's a scoop on that. That's my sort of thought and analysis on what that article said. Sort of another side note here, Florida's a place to buy and invest. We talk about that. A lot of companies, a lot of corporations, REITs, hedge funds, large institutional investors buy property in Florida. Why? Because we are a growing state. Why are they doing that? Well, look, we talk about the stress volume that's coming. This is not just Florida, this is anywhere across the country, but we're looking at minimum 4 million foreclosures happening till we hear a maximum of 10 to 11 million. Can this volume make a difference? Yes, you can. It's what Wall Street's been waiting for, but we need to get ahead of the game, all right? All these 4 million plus properties aren't going to suddenly appear magically on the market where you get to sit back in your armchair and tell your realtor to pick and choose which one you're going to put a low offer on. It's not going to work that way this time. So we got ahead of the game. We got to get ahead of Wall Street, because there will be headwinds that are going to be trying to keep us at bay and not involve ourselves in this, all right? Why do you want to work the stress market? Because you can see, here's my MSA here. Average a median sales price of single family home, the Tampa MSA was $322 back in May. This is the most recent data that I have. A foreclosure REO sale was, again, $246,000. A short sale was $264,000. So granted, there's not many sales going on, but you can see the equity difference right there. That's without even trying, okay? So we know we can do better. That's why you guys need to get involved now as things open up, to get involved with this market, to learn it and figure out how to purchase your primary this way, how to purchase investments. Do it both. That flipped by there pretty quick. Anyway, again, my point is I've got support that can help you do that. Oh, Lord, I'm zooming by too quick here. That's the way things go sometimes on your computer when it's overworked. But anyway, you get the point, right? I've got stuff that I can help you with. Give me a shout. Reach out to me, please, all right? I'll just tell you how to engage the distressed housing market. Just connect with me, Randy, at Luxury Short Sales. Send your information, and we'll make sure we communicate. This is running out, though, guys. I mean, people are going to start to jump on this. I've already seen a lot of inquiries coming my way. A lot of people I used to work with back in the day have already, we're talking about doing things. They're already marketing. I'm partnering with them. There's a lot of stuff going on here. So, a lot of people who are in the know, who understand the real estate market, who do a really good deal or do a number of deals and understand how this is going to play out, they're already getting involved in this market. Don't miss it out, as I say. Don't miss out on, don't miss the second chance at a once-in-a-lifetime opportunity is what I'm trying to say for you, okay? You want information about what's happening in the local market, go to gethousingdata.com, gethousingdata.com. I'm in partnership with Foreclosures.com. It's the #1 provider of distressed property listings in the U.S. Check it out, gethousingdata.com. You can see what's actually happening and watch the distress grow in your market. So once again, thank you very much for the views. Please like the video. Please comment. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to, and reach out to me, of course. There's my information. I look forward to speaking with you guys early next week. See you later.